Hi, everybody, and thank you for joining the London Open Breakfast with myself, Kathleen Brooks, on Wednesday. What is it? Wednesday, the 10th of May, I think. What an interesting couple of days. Certainly an interesting start to the week and some great price action, you're all pleased to know. Much more interesting price action in certain pairs than we've seen for a while. Now, before we, I think the first thing that we have to start with really is euro. Just bear with me one moment while I pull up my chart. Obviously, there's so much from a fundamental perspective going on that is finally starting to have an effect. This here, hopefully you can see it. Yeah, I believe you can see that. If FX Street can just let me know whether or not they can see this. And yes, sorry, someone did correct me. It is the 9th of May, not the 10th. There you go, jumping ahead of myself. Yes, I believe you can see my chart. Now, this is the daily chart in euro dollar. So just to point out to those of you who've been following me or been to this webinar before, this had been the bottom of the recent range, obviously 130 being a really key level. Significant break, I would say. We've opened this morning since London's opened, or London has just opened for 2 minutes, and we've opened a slightly firmer at 129.75 to 80. The low today has been 129.65, but let's make no bones about it. I mean, we are looking weak. This is the daily chart, so as you can see, finally out of this long range. You could even say that the range was actually narrower certainly in the last kind of 6 weeks or so, the whole of April and going into May now. So really nice kind of down move, quite a sharp move lower. As you can see, I have said in the past that kind of long shadows you should be aware of, but long shadows combined with kind of a big key psychological level like 130 can sometimes just be kind of one way to just basically this candlestick here just really shows the kind of the bearish sentiment. So we had a very long shadow on the downside, and it closed lower than the day before, as you can see. And then again, we've had kind of like 3 in a row really. 3 closing days, so this is a trend. So some people, when they actually trade, just from a technical perspective, they wait to see kind of 3 or 4 days worth of events. So they would have looked here. If you look here, say for example at this price pattern, you could have said, okay, fine. I'm a bit concerned at 132 because there you go. There's kind of there's a pattern here which looks like it's a top. Then we have this kind of weird shaped doji, and again, then people would have wanted to see kind of 3 or 4 down days, and now we've kind of broken through that 130 level. Obviously, someone's just asked an interesting question to see if 130 really is a breakout. Should you put your stop loss at or above 130? Interesting. I would probably say slightly above, purely because, 130, it's a huge level, but also euro dollar is the most traded currency pair in the world. So there's going to be a lot of other resting orders going on in there. We know in the past that euro dollar has been very sticky around this level. I would say that what we've got now is a convincing downtrend. Again, things have been sticky before around 130. The high today has been 130.06. The high yesterday was 130.06. So that seems to be the high right now, that 130.05. So some sort of stop loss potentially at 130.15 may certainly in the short term work for you. I would just give I would really like to give, if you can afford to, try and give yourself a little bit of room, because that is a really important level. Don't just dive in and have your stop loss at 130, because we've seen it today go above 130 to 130.06. I mean, there's every chance it could be a false break. Obviously, those of you who trade from a fundamental perspective will say that it's not. everything is aligned. There's a perfect storm almost for the euro. There's a chance now that Greece will have to go back to elections. Not only will it have to go back to elections, but it will have to do it at the same time as it's running out of money. There's a real risk right now. Some people put it at 90% that Greece will get kicked out of the eurozone. In that scenario, even though in the long term that may be better for stability for the eurozone, no one really knows how that will have an effect on the euro. Of course they don't, because it's never happened before, right? One would assume it would have an impact on the euro, but I would say with it, like everything with the euro, the current environment that we're in at the moment doesn't necessarily suggest that we just sell the euro without thinking. You have to have a strategy. You have to, in this environment, keep things very, very tight. We've had to kind of, narrow our time frames pretty much for most of this year because we've been stuck in this tight range. And I would say continue doing the same thing. No one's ever said that the euro goes down a straight line. It doesn't. One of the reasons is because it's one of the most widely traded pairs in the currency block. But also because obviously from a fundamental perspective, yes, you've got everything going on in Europe, but on the other hand, you've got stuff going on in the US as well. And there's some people are looking for more QE in June. So again, sometimes what goes on with the euro isn't anything to do with the euro. Is it a bug light for dumb money? I'm not 100% sure if it's that. I think there's a very good fundamental reason why you would sell the euro right now, especially after the election results we got this weekend, especially after the fact that Europe is changing dramatically from a political perspective. And the political is obviously always going to have a big impact on a currency union like the eurozone. But again, don't expect things to go down in a complete. Don't expect things to go down in a straight line. We certainly wouldn't expect that at all. We think there's going to be a lot of kind of messing around. I would actually say for those of you who aren't necessarily in this trade, wait for a break of 129.50. 129.50 is kind of an important level from kind of a technical perspective. If you go back here, just on the hourly, as you can see, 129.50, it's been rejected before. It's acting as short-term support. So for those of you who want to kind of just hold on, those of you who like the euro lower, who want to maybe just hold on a little bit, we are going to trade down. We believe that we're going to trade lower. However, we think we're going to trade lower in increments rather than just kind of one big sharp shock with the euro. So again, 129.50 is acting as fairly good support right now. Again, on the hourly, as you can see, that's the RSI's turned higher. We could get back up to that kind of 130, but obviously the 21-hour moving average, at 129.95. That could kind of thwart. That's going to be a key resistance level that a lot of people are going to be talking about. That could potentially thwart euro bulls. Someone's just asked about contrarian steps and going along with euro. If that's what you fancy doing, definitely, but I would do it on a very short-term basis. Again, as I said, 129.50 is now going to be a really key level. Regardless of kind of looking at the big overall picture, as you can see, a series of lower lows. Obviously, that was kind of a very long shadow. But if you take that out, let me just move some of these lines are a little bit annoying to watch. But as you can see, a series of lower lows, broken the bottom of that recent range. It does lead us to kind of a new dimension for euro dollar. So definitely kind of watch out for that. There isn't too much economic data coming out today in Europe. Again, it's all about headline risk. Remember, the Greek leader of the far left party, Syriza, I think is how you say it. But basically, he has still got today and tomorrow to form a government. Potentially, the sentiment that he's been coming out with is being jumped on by all the wires going. Right now, it seems that they're only either, we're not obviously privy to the discussions. We have to just listen to the reports. There's a lot of political rhetoric going back and forth with him. He does seem to be kind of stirring up anti-bailout, anti kind of German rhetoric, and then on the other side you've got kind of European officials saying that if Greece doesn't toe the line, they're going to get chucked out of the euro, or they can't stay in the eurozone pretty much. Not as blatant as that, but it's the same type of thing. So it's an interesting one, and it is definitely worth kind of watching out for. Now, someone's just asked for, after breaking down through 129.50, what would be the next support? Let's take a look at my other chart. Just bear with me one moment. I think now is the time to bring in some nice old bit of Ichimoku here. Maybe even a few pivot points, maybe even some Fibonacci. Just bear with me one moment. I know you can't see anything. I'm just pulling up my chart. For those of you who live in London, you'll know how horrific the weather is today. It's been pretty nasty, to say the least, that is for sure. Just bear with me one moment. I'm just pulling up the right thing. Oh, sorry, you can't seem to hear me. I do apologise. Great. So you've got a chart here. So basically, this is a pivot chart. This shows that this is kind of calculated using kind of moving averages and the price history over the last year. And really, what it says is that the main pivot point is 130.18. So now that we're below there, suggests lower. So 130.18 is now the real key resistance level to beat. So I did mention before that kind of 130.15, 130.15 to 20 would be a good place to put a stop loss if you are going short the euro right now, because above there, above 130.18 on a short-term basis anyway, would suggest that we could potentially move higher. 129.70 is the kind of the first or the primary support on this pivot graph, with 129.35 being the secondary support. So that sounds about right to me. We have kind of 129.70, then below there 129.50, then 129.35. So again, very, very tight range, really for euro. It's been, as you can see, not that well, but you can kind of make it out on this chart. Really, the range of movement in euro dollar has been fairly short, fairly tight since the start of this year. It's been kind of 5 big figures. As you can see, you know, the previous 3 months from that, it was much more. It was like 15 big figures pretty much. It was been a very, very tight range. And even though we think that the trajectory for the euro is lower, we don't necessarily think that it's going to kind of surge lower like we saw in kind of October last year. We think it's going to, again, be these kind of incremental steps lower, with, you know, with some kind of 2 steps down, 1 step back type thing, which is why 130.20 is the resistance level to watch, and why kind of there could potentially be stickiness all the way down to kind of 129.35, maybe even down to 128, maybe even all the way down to the 126 lows that we saw, 126.25 lows that we saw in January this year. So do watch out for that. It is important. It is worth, you know, narrow. It's a different type of thing. A breakout. Usually people think, oh great, I'm trading a breakout. I'm going to get on the back of it. I'm going to go right the way down. I'm going to ride a 5-figure move. I'm not 100% sure it's going to be like that for euro, because I think there's too much political risk people don't understand. There's also issues with the dollar and with kind of expectations potentially of more QE. So I wouldn't necessarily say that I would bet the ranch on going long euro. I wouldn't. But equally, I'm going to keep my stops very, very tight. That's how I'm going to play this, because, you know, I want to know, I'm soaking up everything I can. I'm reading everywhere to try and see what levels of the market looking at. What is the market's view on this? Is the market just going to go hell for leather and sell the bottom out of the euro? I don't see that from happening right now. I do see a bearish bias, I do, but I see it in incremental steps, not in one short, sharp surge lower. Hence why I'm looking at every single thing I can, getting my hands on everything. FX Street do a fantastic job of kind of writing up, you know, different little small bits and giving you kind of information about what kind of analysts are saying and stuff like that, because these key levels are going to be what the market's going to look for, and that is technical analysis. Technical analysis is numbers, yes, but it's based on where people who put these numbers in place, and that's why it's so important, and that's why, you know, right now it's all about finding the levels, it's finding the incremental levels. It's about reducing your time frame, reducing maybe your risk parameters as well. Obviously keeping really good stops there, but also kind of taking profits and you know, not being greedy, I think, is the key thing. Don't expect a greedy, you know, jump on the back of a wave lower. I just don't see that happening. Okay, I'm going to also look at Euro, and Aussie. Just bear with me one moment. I know I've spent a ton of time on the Euro, but I think it's really worth it. Aussie, another really interesting one. This is where all the action is going on in the FX markets right now. As you can see, this is Aussie dollar daily. Again, really, really nice move lower. And bearish engulfing candlestick there from yesterday. That comes after the Treasurer Wayne Swan announced that they wanted to announce kind of a very fiscally tight budget to try and bring the government back into, or bring the budget back into surplus next year, which is going to probably give them room. I'll give the RBA room to cut rates. In fact, they explicitly said that. So there's a governmental bias in Australia now for the basically the government has pretty much indicated that it supports lower rates and therefore a lower Aussie. Now we do know that the Australian government have been critical of a strong Aussie in the future, in the past, and worried about its level in the future. So obviously what they've done has been a real kind of slam dunk. As you can see now, only 65 pips away from parity, so real sharp move lower. If we think about it, it wasn't all that long ago. It was the start of March that we were up at 108. The start of May, we were at kind of 104. So this is where we've seen the big move. People say that, we're range bound, it's so boring trading FX. Well, it's not really. You just need to know where to look. After going through kind of 103 or 104 to start with, then 103, which is the decisive level of support there. Then we, as you can see, we're now headed towards parity. We're now headed very close to parity, and I really think that we're going to get there. Looking at it from an RSI basis, we're not quite in oversold territory yet, but we are getting there. So around the one level, I could definitely see us getting very, very sticky. Obviously, that's a really key level. We have been through there before, but if we do get below there, then obviously, as you can see here, 98, 96, so around the 99 level, massive level of support. The parity, funnily enough, the Aussie has tended to kind of break through parity on the downside with relative ease in the past. So even though we think it's going to be, even though it's very symbolic, it's a very symbolic level. 99 is where there's some really, really good support. Now let's just take a look on a shorter term basis. So as you can see here, yes, 100.50, so 108.50, just ahead of parity, is proven to be a bit of a sticky level. Apparently, I heard there were some good buyers out there, so some good official buying interest. Obviously, as you know, the Aussie dollar has taken a larger share of global FX reserves in recent years, so there are official buyers out there. They apparently were getting in at 108.50, so that's a really key level, key support level there, and we're going to need to go through. We're going to really need to get through 108.50 to get to parity. As you can see here, the RSI, a bit of a mixed picture really. It's following price action at the moment. I am looking at this right now. I am a little bit concerned that we had, this was on the hourly, so in the very, very short term, we did try, as you can see here, it's kind of shaven bottom head, or shaven bottom candlestick, as you can see, which means that there's kind of no lower wick. The upper wick quite long actually relative to the size of the body towards 101, but we rejected there actually, and then the hour later we're headed lower again to like kind of 100.50. So we could actually be in a little bit of a very tight range of 50 pip range there with the 21-hour moving average capping things there at 101. Someone's just said Morningstar. It could well be, absolutely. That's what it looks like. Bit of a shaven bottom as well, not quite so nice when you say it like that, but obviously as well I'm also looking at the moving averages here, and that 101, that 21-hour moving average is obviously incredibly important. Couple of things I'm looking at on this chart here. Firstly, the crossover of the 21-hour through the 55-hour, that's bearish, tends to be. Secondly, the fact that it's kind of resting at this 101 is just really, really key resistance there. And then the last thing is looking at the RSI. We kind of, at 100.50, we did start to look oversold, but since then we've kind of gone back to retest that low. So the fact that we haven't really made too much headway above 101.50 is a little bit concerning for me. Someone's mentioned another key level, 100.26 in Aussie dollar. That's an important one. Now, just bear with me one moment. I'm also going to show you the other, just another way of looking at this chart, or looking at this pair, sorry. Because again, it's all about kind of, you know, where should we look for? What are the areas that people are looking at? I would argue that 100.35, as you can see here, this is the Fibonacci just for the past year. I'm just using it on a yearly basis, which encapsulates that high that we saw at above 110, right down to the low at kind of 90, just below 94. Which happened in kind of September. So we're right now smack bang in the middle of that range. 108.35 is a key one. That is the 62% essentially retracement of that 110 high to 109.94 low. So again, kind of a really key significant level. I think just looking at it from looking at this chart from just with my eye, really, you can see here that there's been kind of a lot of weakness in the Aussie for the past year. And how you see that? Oh, is there no chart? You should be able to see it. There is a chart. That's what the technology is telling me, at the chart. You can see it. As you can see here, there's been essentially a lot of weakness in the Aussie. So after getting to 110, then the next high was kind of 108. We couldn't really get above that key resistance level here, which then kind of heralded the fact that, you know, 110 is very much a top. Right now, we're kind of hanging out in the middle. As I said, 108.35, then obviously parity. 108.50 is a key support level as well, as I said, where there have been a lot of rumours today that there's buyers sitting there resting at that level. Below there, then I would kind of target these lows around 99. Then obviously kind of 97.88, so just below 98. And, you know, 95 is going to be a key level as well. So as I said, there's definitely there's two things weighing on the Aussie at the moment from a fundamental perspective. Number one, you have the overall kind of draining number one, you have the overall kind of draining and risk sentiment. Number two, you also have the kind of, you know, what's specific about the Aussie. And someone's just asked a good question about the Kiwi, but what's specific about the Aussie has been you know, the fact that the central bank may cut rates even further. So that's a key thing to point out. Okay, let's just take a look here. Obviously, someone's just asked about kind of pullback. So as I said, there of course there are pullbacks, and you do need to you know, watch out for them. But they're kind of the levels that I mentioned. 101 is the key one to point out to you first. So this is just our Aussie chart. Let's take a quick look at Kiwi. Again, we'll just take a look at it in the hourly just to see what it's been doing, or whether or not it's been following, and has indeed been following that low. So that breakthrough 80 last week very convincingly. Again, finding good resistance, pretty much similar-ish pattern really to the Aussie. Looking fairly weak, did have a bit of a pullback, finding very good resistance at the 21-hour moving average, which is at 78.60 to 70, and then 78.50 is acting as good support at the moment. So an even tighter range really. But right now, just after yesterday's sharp sell-off overnight, market's taking a bit of a breather, and that would certainly be expected. We've seen European stock markets, I believe, have opened. They're lower today, a touch lower today. And as I said, like, you know, it doesn't feel like, yes, it feels like kind of risk will get sold again on any pullback. So do watch out for that. The Kiwi, as you can see, let's take a look at the daily chart on the Kiwi. It is moving at the moment very much in tandem with the Aussie, and that's not necessarily because you know, the RBNZ are talking fairly dovish. Obviously, the Prime Minister sounds very worried about the level of their currency as well. And then added to that, you've also got the fact that risk sentiment is being we've also got the fact that the the Kiwi is a risky currency and it's getting hit by by risk sentiment and changes in risk sentiment. So that is certainly kind of worth watching out. Obviously, 78.50 acting as very good support. Below there, 78. Someone just mentioned, can candles before London Open often mislead the market? Not just candles that can mislead the market, just after or just before the London Open, prices can too, largely because the London Open, a bit like kind of the US Open, the first half hour is a bit weird. It can be a bit weird anyway. Like yesterday, for example, it did look like we may have recovered a little bit in euro, but then as the kind of the data came out, as the kind of headline risk came out, then we saw things really start to move. And that sometimes at around 8 o'clock you have these kind of fixes, which is kind of, banks and other kind of dealers essentially putting through big orders, usually for kind of international clients, or not international clients, institutional clients, official clients, that type of thing. And that can definitely upset things. Added to that, if you think about, a really good way of looking at the market, I always think, and this is why, we have an office obviously in the US, and what my US colleagues do is actually very different to the job of an analyst in London. Because of the way the markets work, you go from Asia. Asia takes its cue from what happened in the US and Europe. You then start Europe almost like a clean slate. So the markets do take a while to settle down to decide what it is they're going to do, what direction are they going to go in. Are the bulls going to have, are the bulls going to take the win? Are the bears? Then what you look at is then throughout the European session, you get the, the headline risk. The economic data comes out, then you get the kind of the price action once those decisions have been made about whether or not it's bulls or the bears. Like yesterday, for example, opened and it looks like the bulls might have helped things or certainly pushed things through and pushed us back above that 130 level in euro dollar, and then kind of within a few hours we were back below 130 again. Obviously, at the moment when the US opened, yes, the US is having a bit of an impact, but really a lot of what's going on, a lot of the agenda is being set in European hours. So do watch out for that, because then obviously when you trade the US session, things are in place. So as kind of certainly as I was saying, colleagues of mine, their jobs as analysts are very different in the US session than mine is in the London session. Because in the London session, we're kind of setting the agenda. There's not too much price action to talk about because we're the bulls are kind of divvying up, working it out with the bears who's going to win that day or that hour or that minute in some cases. But as you can see, it doesn't take away from the fact that it's always definitely very good to look at what price action is done overnight. It's always very good to look at kind of change the time frames around a little bit, see what the overall direction is. And then sometimes, we get a raft of data out at like 8 o'clock or 7 o'clock in the morning, say, in London time, and then by 8 o'clock, the markets are on their way. They're moving the way they should be. And someone's just mentioned as well about the S&P leading the way from 2:30 time. Well, I mean, that's true. Kind of between 2:30 and 4, obviously, the US the US stock market opens at 9:30 Eastern time. And then that kind of leads the way. Someone's just asked about Euro-Yen, which I'll quickly answer. Euro-Yen, we think generally is going to head lower, but we think it's going to be a little bit range-bound this morning. 103.40 is the low on the downside. 103.90 is the high. Obviously, getting below 103.50 is a really key level. If we stay below there, then I think we could potentially test 103. So hopefully that is useful. Thanks, everyone, for joining. Please do join me on Friday. Good luck trading out there. I know it's fairly complicated market, a lot of pictures, but watch out for headline risk. Do watch out also for those key levels that I mentioned. So thanks a lot, everybody. Bye-bye.